And so over here you've got XAU, that's 1,000 ounces of 1,000 ounces of gold. XAG is 5,000 ounces of silver. Monumental numbers when you think about that coin. See, I've lost it already. Oh, I passed it round. Did I pass the gold coin round? No, the gold. Oh, there it is. So, you know, when you think about it, someone says that they've bought, you know, 1,000 ounces of this stuff. They haven't bought anything of the sort. They've paid a small premium to take control of paper. 1 ounce of this stuff, there are 99 ounces of paper. 99 ounces of paper. So when the world nasty dose of medicine, what we found is everybody, as how does the saying, you don't really see who's swimming naked until the tide goes out. And what we discovered in the world last year, there were a lot of people swimming naked. They had the look, they had so much position, but when they had what we call a margin call, they had to cash in what they had. They thought that they could control 100 of this or 1,000 of this with just a small amount, and suddenly they watched the price plummet. They had to get out of their position. Everyone that was borrowed up to the eyeballs, we've seen it in property, had to get out of their position. Landlords overcommitted and speculative mania suddenly realised they've got one rental property too many. It didn't matter what asset class you were in last year, everything, gold included, because it has so much paper or just empty money. It took an initial drop and then just literally surged back. Everything else is yet to do that, and they're talking still in terms of years before it will. In fact, when you were to look at the disasters of the recent times, and if you weren't to look too closely at the dates that I've set up, you could wonder where was October on that timeline. You could say, oh well, maybe that was October. But in fact, it was right there. And as you can see, gold and Kiwi dollars literally just, well, in all currencies, it just went down and literally then just took off. Most people don't want to tend to pay attention. They just think, oh, well, gold got knocked back like everything else did. They sort of forget that gold took off. Quickly took off, because I've had to add that in last night because it went up to over $2,000. Here it is, 8 straight years of gains in all currencies. Gold just keeps going up. In Kiwi currencies, we've watched gold hit $2,000 recently, just literally in the last month. And it's gone down to here right now because our dollar's climbed, and whilst the American gold has gone up in price, our currency has got stronger, which has nullified it. But then what will happen, like always happens, our currency will suddenly get a bit of a kick in the guts, and gold will continue to hold its place, and you'll just watch another surge. I'm about to do an article for our next newsletter, and I'm actually going to show the classic 8s rowing races where you see all the boats, and you can never tell when you look at a perspective as to which one's quite in front. Not until suddenly they all come into the frame right at the end, and you suddenly see, oh right, we're coming last. Well, that's what gold is like. It surges. It surges back and forth in what currency you happen to be in and what country you're in. And you don't quite realise that unless you're actually invested in it, you're actually being left behind, because you can get too fixated on the spot price of the day. And so a major event has probably occurred that is the sort of thing institutions, you see, you have to understand that in a typical bull market in gold, does everyone understand what a bull is? You know, they've got that bull down there in New York and Wall Street. I've stood outside and had my picture taken. Most people do that. The bull that sits in front. Bull is representative of a charging forward upward market. A bear is, I don't know why, I think bears are fairly nasty, grisly, ugly things, and if they want to have a piece of you, you're in trouble. But bears generally symbolise the going down, a bear market down, a bull market forward. And so what we're seeing is institutions, because in a classic bull market there is an order at which people climb in to gold. The smart money climbs right back at the beginning, around about 2000, when gold was only $250. Then you start to get optimistic people start to get involved. Still a lot of scepticism, but not complete derision, because generally the price has gone up, so you can't completely dismiss them. Then you'll get to a point where institutions start to take note. These are people that represent, fund managers. That you don't know what to do with your money. You go to a fund manager who says, I'll go and invest it in this gold mining company or that. Institutions have been buying gold at record rate. They are now the 6th largest, the Street Tracks Gold Index, which is a gold holding, is the 6th largest gold holder in the world in terms of countries. So you've got countries. America has 8,000 tonnes, and you go down this pecking order of who holds the gold. And most of that gold is coming in from institutions because they understand they have to be positioned. They know what is happening. The last people to ever climb in on a real gold market is that last meteoric virtual climb, and that's when the smart money is actually starting to get out, because they realise that this is looking really like a rocket ship. And so you see it the same in property. Just right at the end of a property bull market, it just seems to be renovate my home, the program after program on TV. You've got to get in, you've got to get in. And invariably there's this whole group of people that are getting in, right, just as the smart money has been getting out. Institutions look at graphs like this because in history there have been 3 major crossings. Every 18 years, the Standard & which is, well, it isn't exactly the market, but it does cover the top 500 companies in America that are on the share market, and it represents 3/4 of the total capitalisation of the entire US stock. So as far as looking at world indexes, whether it's the NASDAQ or the FTSE or the Hang Seng or all these different indexes, the world share markets, the NZX, you don't look at the NZX. The ASX, no, you don't look at the ASX. You look at the big indexes. Well, you want to look at the biggest index? You look at the SP 500, Standard & Poor's 500. And every 18 years, 1 ounce of gold costs more than the S&P 500. So you take all the shares of these companies and add them together, and you come up with an amount. You might say it costs you $800 right here to buy 1 share of every one of those companies. And every 18 years, one of those is worth more than the entire 500, a share in each one of those. And then 18 years later, it goes the other way. So you have a period of time where the share market makes gold look a stupid investment, and then they trade places, and then they trade places back. It happened back in 73, 18 years later, 91, and about a month ago later it crossed again. Right here at 829, gold is now, if we were to draw the line, gold would be up at its 950, and the S&P would be going back down. Down here you can see that typically what happens when it crosses, you get a complete bell-shaped bottom that will go from anything from 5.5 to 7.5 times. So you think about it. The S&P 500 might be 700 now. Say it goes down to 500. And then go multiply that by an ounce of gold by 7 times, you'll come up with $3,500. This is what's been happening in history. There is a complete multiplication factor at the bottom of a cycle where gold ends up being worth far more than an equivalent amount of money invested in the share market. So smart money recognises this and moves in and moves out, always ahead of the crowd. So if we were to look at probably one of the most famous gold prognosticators who's put this graph together years ago, his turns have been very good. He's not perfect, Jim Sinclair, but he's very, very good. Been in the game, he's an old codger now, been in the game a long time. I was very impressed the way back in 2008. He didn't quite get the bottom and he didn't quite get the top, but I mean, gold made $1,000 when Bear Stearns crashed last year. His timing was impeccable. Just like his timing was impeccable here. He's generally been just a little bit conservative. It's ended up dipping a bit lower or going a bit higher. And he bet Wall Street $1 million. He put the money up and said it can be held in a trust account. The gold is going to 1650. No one wants to take his bet up. No one wants. He's prepared to put the money up and have it held in trust. No one wants to take his bet up.